Good morning, good afternoon, and good evening. Wherever you are joining from today, a very warm welcome to our webinar, Trade Finance 2026, Digital Agility, Compliance, and the Race to Paperless Trade. I'm Desmond Ng, Marketing Director at INFOPRO, and I'm really glad you are here. Over the next 1 hour, we are going to cover mainly 5 parts. Here is the roadmap. Part 1, the new regulatory reality for 2026. We will cover the deadlines, the fines, and what's explainable AI is no longer optional. It is now a legal requirement. And for part 2, we'll be covering a parallel reality that too many trade finance professionals overlook: Islamic trade finance, the market size, the Sharia compliance requirements, and why conventional technology will not work. And for part 3, we'll cover how leading institutions are using AI to detect fraud in real time, process documents intelligently, as well as turning compliance pressure into competitive advantage. As for the fourth part, the ICC's paperless trade playbook will cover in terms of what it is, why it matters, and what it means for your daily work. And for the fifth or final part, we'll cover the practical 5-step roadmap that you can actually take. And for now, I know some of you are trade finance veterans. You have seen and you have heard of concepts such as letters of credits, bills of lading, as well as bank of guarantees. And some of you might be newer to this space. Maybe you are a compliance officer who just inherited trade finance, or a technology leader trying to understand the business requirements. That is all perfectly fine, as I will explain these concepts as we go on. And hopefully everyone will walk away with something valuable, whether there is a deadline you did not know about, a question you need to ask your correspondents, or a framework for your next technology investment. And I also want to introduce something upfront, because you are going to hear this particular terminology and name a lot, which is the ICC. The ICC here stands for International Chamber of Commerce. And International Chamber of Commerce, or ICC, they are the global rule makers for trade. Every letter of credit you have ever seen, every single one, follow the rules written by the ICC. And right now, they are leading the charge to make the trade completely paperless through MLETR, as well as the paperless trade playbook. So when I reference the ICC, you understand why their voice actually matters. And here's the big idea for today, the one sentence I want you to remember after you close your laptop. Compliance pressure, it is not going anywhere. But institutions that master digital agility will turn that pressure into a real competitive advantage. The banks that wait, they will drown in problems such as manual reviews, audit findings, margin erosions, and so on. And for the banks that act, they will process faster, comply more easily, as well as winning more businesses. And let's get started. Before we dive in, a couple of quick housekeeping rules. First, in terms of the legal stuff, this presentation is for informational purposes only. It is being recorded. The content is proprietary to INFOPRO. And secondly, and more importantly, let me explain how we are handling questions today. We will take all questions throughout the presentation today. And here's how it works. Just type your questions directly into the chat. At any time during the presentation, you do not have to wait until the end. Our team will monitor the chat, and at the end, I will work through as many questions as the time allows. But here is the reality. As we have quite a large audience today, we may not get the time to address all of your questions. So here's our commitment to you. For every question submitted in the chat, every single one, our team will review it, and you should receive a personalized written answer sent directly to you. For complex questions, we may even schedule a quick follow-up call with you. And so if you have any questions, please ask. Whether you are a beginner trying to understand the conceptual terminologies such as EBLs, or you are a compliance officer dealing with a specific regulatory challenge in your jurisdiction, or somewhere in between, type your questions into the chat and we'll answer. And first, about INFOPRO. INFOPRO has over 40 years of experience in banking technology. That is nearly 4 decades of deep domain expertise. To date, we have served more than 100 financial institutions across retail, Islamic, as well as commercial banking sectors globally. We have invested in over $150 million in active research and development, ensuring our platforms remain ahead of industry curve. Our team includes more than 300 banking and technology experts dedicated to helping institutions like yours to navigate digital transformation, compliance, as well as modernization. And here is a statistics we are particularly proud of. Every single INFOPRO deployment has been delivered on time and to specification without exception. That is 100% implementation success across every customer, every country, and every project. We do not just sell ordinary banking software, we deliver the outcomes. And in terms of our global footprint, it spans across 32 countries, covering 5 regions. This global presence matters to you because the challenges we are discussing today in terms of compliance, digital agility, paperless trade, these are not regional issues. They are indeed global issues, and INFOPRO brings global experience to every client engagement. Our work has indeed been recognized by leading industry bodies around the world. We have received the Best Core Banking Software Provider Award, which is a global recognition for delivering robust, scalable core banking infrastructure across diverse markets. We have been named Best Islamic Financial Software Provider, whereby our Sharia-compliant technology solutions are recognized for innovation and compliance rigor. Additionally, we have received Best Technology Innovation recognition for our API-first cloud-ready banking architecture at enterprise scale. We are also proud recipients of the Digital Banking Excellence Award and Global FinTech Leadership recognition for sustained impact in advancing financial technology across emerging and developed markets. These are indeed independent validation that INFOPRO delivers technology that works at scale across jurisdiction and through regulatory change. But awards are not our only focus. Our focus is your success, and that brings us to our platform. At the heart of INFOPRO solution is our modular banking platform. And what does modular here means? It means you do not need to replace your entire core banking system to adapt to new capabilities. One module at a time, our platform is API first, whereby it connects seamlessly with your existing systems, SWIFT, potentially your blockchain platforms, as well as regulatory reporting tools. In terms of cloud readiness, it could be deployed on-premise in the cloud or even hybrid. The choice is yours. In terms of scalability, whether you process 1,000 trade transactions a month or 1 million, the platform grows with you. And in terms of compliance native, we have audit trails, explainable AI, and regulatory reportings, which are inbuilt and not bolted on. And we have designed this platform specifically for the challenges we are discussing today, which is the regulatory pressure, digital agility, and the race to paperless trade. Now, with that context on who we are, let us turn the state of global trade finance and why paper is the problem. $30 trillion. That is how much goods cross border every year. In 2025, international trade reached an unprecedented scale, connecting manufacturers, suppliers, and consumers across every continent. From the shipping factories in Southeast Asia, shipping components to China, from the agricultural producers in South America, sending grain to Africa, from the manufacturers in Europe exporting machinery to the Middle East. Behind every shipment, behind every container, every vessel, every truck, every train, lies a sophisticated financial engine. And that engine, we call it as trade finance. But here's the reality that the headline number does not show. The financial engine, the one that moves 30 US trillion worth of goods every year, is running on infrastructure that belongs to the 19th century. While the rest of the banking has gone digital in terms of payments, accounts opening, lending, trade finance is still anchored by mountains of papers. I will show you what I mean as we go along the presentation. Let me paint a picture of just how big global trade really is. In 2025, international trade reached 30 trillion US dollars. That's $30,000 billion worth of goods moving between countries. Example, phones from Vietnam, cars from Germany, coffee from Brazil, medical devices from the US. Behind every one of these lies a financial engine called trade finance. It's how exporters get paid, how importers get goods, how risk is managed across borders. Here's the catch. That engine is still largely powered by paper. Physical documents, courier envelopes, wet signatures, and this is slowing everything down. The trade finance market itself is worth 12.3 trillion US dollar. 80% of cross-border transactions rely on some form of trade financing, such as letter of credits, guarantees, bill of exchange. Yet there is a 1.7 trillion financing gap. That's money that small and medium-sized businesses in emerging markets simply cannot access. Why? The key reason is because paper-based processes make it too expensive and too slow to serve them. Paper is not just inconvenience, it is excluding businesses from global trade. For centuries, global trade has been anchored by mountains of paper. It is slowing commerce, trapping capital, as well as exposing businesses to unnecessary risks. Think of it like this. Every time a ship moves, a stack of paper travels with it, be it by courier, by fax, by email attachment, and every stop creates a chance for delay, loss, or even fraud. This is what we call as the paper prison, and this is costing billions of dollars. Let me explain a key concept here, the bill of lading, which often abbreviated as BL. Imagine you are a factory in Vietnam shipping 10,000 smartphones to a buyer in Germany, let's say. The goods are loaded onto a ship container. They will take 3 weeks to arrive. How does the buyer actually prove they own the goods while the ship is still at sea? How do they get the bank to release the payment? The bill of lading is the answer. It is a document issued by the carrier, which is the shipping line. It has three critical functions. First, it serves as a receipt. It proves that the goods were loaded onto the ship. Second, it serves as a contract. It sets out the term of carriage, where the goods are going, who is responsible for what. And thirdly, and most importantly, this is a title document. Whoever holds the original bill of lading owns the goods. It is like a car title or a house deed, but for a shipping container. For centuries, the bill of lading has been a physical piece of paper, and that paper has to travel, let's say, from Vietnam to Germany in our example, by courier, taking probably 5 to 10 days. And during that time, the goods are sitting in a port at the destination, or sometimes still on a ship, and the buyer cannot take possession. The factory cannot get paid. The bank is waiting for documents. A single container shipment can require up to 50 original documents, passing through 30 or more parties, such as freight forwarders, custom brokers, banks, insurers, and probably port authorities as well. And each individual touch point adds a cost, time, as well as risk. And paper is still the key bottleneck here. McKinsey estimates that paper documents account for 10 to 30% of total trade documentation costs. There are roughly 4 billion paper documents active at any one time, such as the bills of lading, invoices, certificates of origin, packing lists, insurance certificates. We are trying to run a 21st century economy on a 19th century paper system, and this is indeed not working. Billions of documents are generated annually, each one with a potential point of failure, delay, or even fraud. A single missing signature, a lost courier envelope, a forged document, and a shipment stops. A payment is delayed and a relationship is damaged. Here is the real tangible cost of paper. Paper Paper-based bills of exchange, another common trade instrument, can tie up working capital for up to 2 weeks. Working capital is the cash a business needs for day-to-day operations. You need to pay your suppliers, meeting payroll requirements, you need to invest in inventory. And why 2 weeks? Because printing, signing, endorsing, and physically delivering paper documents takes time. You cannot release payment until the paper arrives. Billions of dollars are frozen across the global trade ecosystem at any given moment. Capital that could be used for growth, for hiring, for innovation. Every physical touchpoint, every envelope, every fax, every manual data entry is a compliance exposure, a fraud opportunity, and a delay to cash flow. Let me summarize the impact of paper in terms of transaction delays. Paper adds 5 to 10 days to average trade cycles. That is 5 to 10 days of working capital tied up, 5 to 10 days of risk, 5 to 10 days of uncertainty. In terms of elevated fraud risk, paper instruments are vulnerable to forgery, duplication, and interception. A paper bill of lading can be stolen, a paper invoice can be falsified. And for SME financing gaps, small and medium-sized exporters bear a disproportionate burden. They have slower onboarding, higher documentation preparation costs, and delayed financing decisions, all because of paper. And paper is a risk multiplier. And that brings us to 2026, where regulatory pressure is about to change everything. I want you to hold that thought. 2026 might be a different year because it is the bridge between everything we have just discussed and everything we are about to cover. All of those problems we just talked about, the paper, the delays, the fraud, the trapped capital, the SME financing gaps, these are the actual problems which have been with us for decades. Some of them probably for centuries. But what makes 2026 different is not the problems, it is the deadlines. Because in 2026, regulators are no longer asking politely. They are not issuing gentle guidance. They are not offering extended grace periods. They are indeed drawing lines in the sand and they are attaching real consequences, financial consequences to those lines. Let me show you what I mean from my next slides. Think of SWIFT as the postal service for banks. For example, when Bank A in Singapore wants to send a payment instruction to Bank B in London, they do not call each other on the phone. They do not send emails. They send a SWIFT message. That message contains all the information needed to execute the payment. Information such as the sender, the receiver, the amount, the currency, the account numbers, the address details, the purpose of payment. SWIFT delivers that message securely, reliably, and quickly. It does not move the money, but without the message, the money does not move. And now, why does this actually matter for trade finance? Because trade finance runs on SWIFT messages. When a letter of credit is issued, SWIFT message carry the LC details from the issuing bank to the advising bank to the confirming bank. When a payment is made under a LC, SWIFT messages carry the payment instructions. When a bank guarantee is called, SWIFT messages carry the demand. Every major trade finance transaction, every single one, touches SWIFT at multiple points. And here is the critical point for this webinar. SWIFT has decided to retire its old message formats, the formats that has been used for decades, such as, for example, MT103, MT202, MT101, and many others, are being replaced by a new standard called ISO 222. The old formats are being turned off permanently. And the deadline for that turn off is at 14 November 2026. That is why this matters to you. This is why every trade finance professionals need to understand SWIFT. If you touch cross-border payments, you touch SWIFT. And if you touch SWIFT, 14 November 2026 is your deadline. Now, let me show you what that particular deadline actually means for your daily operations. As mentioned, SWIFT is retiring its legacy MT message formats, MT103, MT202, MT101, all of them gone. And this is not a gradual transition with extended grace periods and friendly reminders. This is a hard cut over with binary consequences. Either you are ready or the payment will fail. There is no in between. Let me walk you through the timeline on this deck, row by row. The first row in terms of November 2025, whereby this particular date has already passed. MT103 and MT202 support was discontinued. If your institution is still sending those formats, and some of you probably are, you are already paying contingency fees. Every transaction, every day. The cost is adding up right now. And under the second row, November 2025 to November 2026, this is the transition period. During this window, all address formats are still accepted. SWIFT is being accommodating. They want to give the industry time to migrate. But here's the catch. Every converted message, every time your system sends an old format that has to be converted to the new format, exposes you to fees. And those fees are not trivial. They add up. At volume, they can wipe out the margin on an entire trade lane. And for the third row, 14 November 2026, this, you can consider that as the wall. On this date, unstructured addresses will be rejected, not flagged for manual review, not returned for correction with a polite note. It will be rejected. The payment will not go through. And let me be crystal clear about what rejected means in operational terms. It means your straight through processing rate drops to zero for any transaction that touches an unmigrated counterparty. It means your operations team spends days investigating failed payments, calling correspondent banks, and manually reprocessing transactions. It also means your corporate client's supplier does not get paid. The container sits at port, the demurrage charges start accumulating, and your client calls their relationship manager angry and you have no good answer. Now, what specifically changes for trade finance? Three things. One, the MT101 messages. MT101 is the message type for payment instructions. After November 2026, any MT101 sent with unstructured address fields will be rejected. That is not a technical nuance, that is your core payment flow. And secondly, hybrid address formats become mandatory. The free text address fields that we have all relied on for decades, the ones where you could type anything and SWIFT would accept it, those are going away. You now need semi-structured, validated address formats, whereby every field has a purpose, every field has a validation rule, and every field must be populated correctly. And three, exception and investigation, E&I, moves entirely to ISO 222. Your manual exception handling workflows, the ones where your team calls correspondent banks, send faxes, and leave voicemails trying to track down missing payments, those workflows will break if you are not on the new standard. And here is the hidden risk, the one that keeps compliance officers awake at night. The weakest link in your correspondent network determines your exposure. Let me say that again. Even if your bank is fully ISO 222 ready, even if you have tested every system, trained every operator, validated every address format, you remain exposed to every counterparty in your transaction chain. If your correspondent bank in a key trade corridor has not migrated, their failure becomes your failure. If your corporate client in Southeast Asia is still sending MT101, your payment fails. That is not a solo journey. This is a network problem, and you are only as strong as your weakest partner. So the question is, how do you protect yourself? And the next corresponding slide, I'll be sharing with you a cascade. This is what I call as the compliance cascade. Look at this chain. It starts with you, your bank. Your bank, which is fully ISO 222 ready, for instance, with a green check mark. You have done the work. You have allocated the budget. Your IT team has run the test. Your operations team has trained on the new formats. Your legal team has reviewed the compliance implications, and you are confident. But the chain does not end with you alone. And the correspondent bank A, which has done probably partial migration, they are somewhere in the transition period. Maybe they have completed 60% of their testing. Maybe they have migrated their high value corridors, but not their emerging market routes, as an example. Maybe they are waiting for a regulatory push from their local central bank. They are not fully there. And what does that mean for you? Contingency fees. Every transaction that routes through them costs you extra. This is not a disaster, but at a volume, those fees will add up. And when they add up, your cost base and your margin indeed stays the same. That is a squeeze. As for correspondent bank B, as an example, whereby the problem here is in terms of unstructured address only, whereby they have not started the migration. Maybe they are waiting for an extension they assume will come, or maybe they are hoping the industry will move slowly. Maybe they are just do not see the urgency. Here's what happens on 14 November 2026. Their messages will be rejected, not slowed down, not delayed. It will be rejected. And any payment that routes through them, any transaction that depends on their messaging infrastructure will fail with them. As for corporate client C, which is still using MT101 payment instructions, maybe they are a small exporter in a developing country. Maybe they do not have a dedicated trade finance team, or maybe no one has told them about the deadline. Maybe they were told but did not believe it. When they send an MT101 to you and you forward that instruction down the chain, correspondent bank B, here's what happens. The payment will fail. Your client supplier does not get paid, and the goods continue to sit at the port, and the client will be calling you. And here's the brutal operational reality. Your client does not care which bank in the chain caused the failure. They do not care that correspondent bank B did not migrate. They also do not care that your corporate client C sent an MT101 message format. They do not care about Swift message format. They only know that their payment did not arrive, and they will hold you responsible for it. Because you are their bank, you are the only one they trust. You are the one that they'll be calling. And let me share a reality check. Industry testing that was conducted in October 2025, this testing involved dozens of major banks and thousands of test transactions. It actually showed that a significant portion of cross-border payment instructions still fail the validation process due to address formatting issues. And we are already past October 2025. The testing phase is over, the transition period is active, and failures are still happening in production environments. This is not a theoretical problem. This is happening right now at real banks with real client money and in real trade corridors. So the question is, what do you do? Our recommendation is for you to run a correspondent bank readiness assessment before September 2026. That gives you 2 months, September and October 2026, to identify exposed corridors, assess alternatives, as well as building contingency plans to your highest volume routes. Do not wait until October. Do not assume your correspondents are ready. Do not assume the industry will magically figure it out. Verify, document, and plan. And to help you do that, let me give you 4 specific questions that you need to ask every counterparty today. These 4 questions are your readiness checklist. Ask them to every correspondent bank. Ask them to every major corporate client. Ask them to every partner in your trade finance ecosystem. And do not accept any vague answers. We are working on it. It is on plan. It is a priority. It is not a timeline. Get specific evidence. Get names and dates. And some of the key questions. Question 1, end-to-end testing. Have you completed ISO 222 end-to-end testing? Not have you started testing? Not is testing on your roadmap? Not we are planning to test next quarter. In terms of completion, ask for details. When did testing start? When did it finish? How many message types were tested? What was the pass rate? How issues were found? How were they resolved? A counterparty that cannot answer these questions has not completed testing. And question 2, in terms of MT101 retirement. Example questions. What is your timeline for retiring MT101? MT101 is the payment instruction message type. It is one of the most commonly used formats in trade finance. Get a specific date. Q3 2026 is not a specific answer. Ask for the week, ask for the milestone, ask for the internal deadline they have committed to. And here is a follow-up question. What is your fallback plan if you miss that deadline? Because deadlines get missed, good counterparties have contingency plans. Bad counterparties hope for extensions. Question 3. Pain001 capability. Can you send and receive pain.001 messages? Pain.001 is a specific ISO 222 message type for payment initiation. It is the successor for MT101. This is a binary question. Either they can handle pain.001 or they cannot. There is no partial credit. If they say yes, ask for proof. Ask for a test confirmation. Ask for the date which they have successfully produced a pain.001 message in their production. If they say no, or if they hesitate, or if they say we are working on it, that is a red flag. The counterparty is not ready. And question 4, in terms of client awareness. Do your corporate clients know the deadline? Because even if your correspondent bank is fully ready, even if they have tested everything, retired MT101, as well as implemented pain.001, their clients might not be ready. And when their client sends an old format message, your correspondent bank has to deal with it. That means delay, that means manual intervention, that means risk. Ask, what are you doing to educate your corporate clients about the deadline? What communications have you sent? What training have you provided? What is your plan for clients who are not ready by November 2026? Let me give you a framework for having these conversations. Do not send an email. Do not rely on your relationship manager to mention it during a quarterly review. Schedule a dedicated call. Put these 4 questions on the agenda in writing in advance. Send them to your counterparty's compliance officer, as well as their operations manager and their relationship manager. Take notes, document the answers, follow up in writing to confirm what you have heard. And if you get answers that make you uncomfortable, if a key correspondent bank cannot give you a clear, specific, documented answers, then you have a decision to make. Do you continue to route high-value trade flows through that counterparty? Do you build alternative routing? Do you accelerate your timeline for switching correspondence? These are not easy decisions, but they are easier to make in September 2026 than in November 2026. Because on 14 November 2026, VAC does not protect you, readiness does. And now let me shift from SWIFT and messaging standards to the broader question of how you build digital agility in your trade finance operation. Those 4 questions are your starting point, but they are not the full picture. Because the ISO 222 deadline, as urgent as it is just one piece of much larger shift in the regulatory landscape. Let me zoom out and show you the bigger picture, because what is happening with SWIFT is happening everywhere in trade finance. And the institutions that understand this shift, that see it is coming, are the ones who will lead. Now, let me share statistics that every trade finance leader in this particular forum and every leader watching the recording needs to internalize. According to the 2024 Trade Technology Survey from most rigorous source in our industry, 53% of global banks now cite escalating compliance as their single greatest operational challenge. 53%, more than half. Now, let me put that number in perspective for you. For the first time in the history of this survey, and this survey has been running for nearly a decade, compliance burden has overtaken technology investment as the number one challenge facing banks. Think about what that means. For the last 10 years, the narrative in banking has been digital transformation. For example, legacy systems replacement, cloud migration, core banking modernization, artificial intelligence adoption. Technology spend was always the headline, always the boardroom priority, always where the budget battles were fought. And all of that still matters. I'm not saying that technology is unimportant, far from it. But today, more than half of banks are telling us something different. They are indeed saying our biggest problem is not our technology. Our biggest problem is to keep up with the rules. I call this as the intelligence gap. Here is what is happening. More rules are being issued every year by more regulators in more jurisdictions with more overlapping and sometimes conflicting requirements. At the same time, there is less visibility into how those rules actually apply to your specific situation. For example, your specific trade corridors, your specific counterparties, your specific financial instruments. The rule book are getting thicker, the guidance is getting thinner. And here is the critical insights that separates leading institutions from laggards. Banks can no longer buy their way out of this problem with new platforms alone. You cannot simply purchase a new compliance system, implement it, check the box, and move on. That worked in probably 2015, but it does not work in 2026. The problem is not the absence of software. The problem is the gap between the data you have and the decisions you need to make. You have the data and lots of data, such as transaction data, counterparty data, shipping data, compliance data, sanctions list, adverse media, beneficial ownership records. But turning that data into some sort of confident, defensible, timely decisions, that is the hardest part. That is the intelligence gap. And closing that gap requires more than technology. It requires context, it requires judgment, it requires the ability to explain not just what you decided, but why you have indeed decided it. So what happens if you do not close that gap? Let me show you what is at stake. This slide answers a simple but urgent question. What is actually at stake in 2026? And the answer is the cost of non-compliance is rising faster than trade volumes. That is the key dynamic you need to understand. Global trade is growing. Your transaction volumes are growing. But compliance costs are growing even faster. And that gap between revenue growth and cost growth is where margins get squeezed, where profitability erodes, where institutions that fail to adapt get left behind. Let me walk you through the regulatory pressure points driving this trend. First, explainable AI mandates. New global mandates now require explainable, transparent AI in every compliance decision within trade finance. This is not a recommendation. This is not a best practice guidance from an industry association. This is a requirement from regulators. The European Central Bank has issued guidance. The Monetary Authority of Singapore has issued requirements. The OCC in the United States has made it clear. They want to see the logic behind every sanctions flag, every compliance alert, every approval or rejection decision. If your AI cannot explain itself, regulators will treat it as a black box. and black box audit will fail. Second, in terms of TBML enforcement, regulators are aggressively targeting trade-based money laundering, TBML. This is not a future risk. It is not a theoretical concern. It is a current enforcement priority across multiple jurisdictions. Why? Because regulators have realized that traditional anti-money laundering controls, which focus on payments as well as customer accounts, miss a huge portion of financial crime that hides inside trade documentation. Over-invoicing, under-invoicing, duplicate financing, phantom shipments, round-tripping. These are not academic concepts. These are enforcement actions happening right now, and regulators are demanding full auditability of every automated process that touches trade compliance. Third, in terms of Swift blockchain integration, Swift blockchain integration, which is coming, whether we are ready or not, promises faster settlement. That is the good news. That is the promise of the technology. But here is the trade-off. Faster settlement also means stricter proof of compliance requirements at every transaction node. Think about what that means operationally. In a blockchain-based trade finance environment, transactions settle in minutes or seconds. That is great for working capital, that is great for supply chain velocity, but it means your compliance checks have to happen in minutes or seconds too. There is no back office batch window to catch problems the next day. There is no, we will review it in the next morning. Speed without compliance is just faster fines. Now look at this curve, the regulatory cost curve versus trade margin. Let me walk you through the 4 scenarios on this particular chart. Under the top left quadrant, low compliance costs, high revenue. This is where everyone wants to be. High margins, low regulatory burden. You are processing efficiently. You are complying effectively. Your profitability is strong. But here's the truth. The window is closing. Compliance costs are rising across the board. No institution is immune. No geography is exempt. Under the top right quadrant, low compliance costs, stable margin. This is where you might be if you operate in a low regulation jurisdiction with simple trade corridors and limited correspondent relationships. But that is not most of you. And for those of you in this quadrant, the question is not if compliance costs will rise. The question is when. Under the bottom left quadrant, high compliance costs, high revenue pressure. This is where you feel the squeeze. Revenue is still there, your trade volumes are healthy, your clients are active, but compliance is eating your margin. This is uncomfortable but survivable for a while, but every year the squeeze gets tighter. Every year you have to process more transactions with the same or smaller margin. Next, bottom right quadrant, high compliance costs, low margin. This is where you do not want to be. This is where institutions that treat compliance as a back office cost rather than a strategic priority will find themselves by late 2026 or early 2027. Low margin here means no room for error, no room for investment, no room to attract and retain talent. It is difficult place to operate and even harder place to escape. Here is my message to you. Compliance is no longer a cost center. It is a margin driver. Get it right, build intelligent, auditable, explainable systems, and you protect your profitability. You process faster, you win more clients, you sleep better at night, and if you get it wrong, you will continue to rely on manual processes and black box tools, and your margin disappear. Slowly at first, then all at once. The choice is yours, but the clock is ticking. And to make this real, let me give you specific numbers because regulators are no longer issuing warnings, they are issuing fines. Let me give you 4 numbers. Each one tells a story. Together, they tell a warning that every trade finance executive need to hear. Number 1, TBML fine increases 3 times higher. The average global fine for trade-based money laundering has risen. It has risen to threefold in just 3 years' time. Let me put that in a perspective. An $8 million fine is painful. It gets the board's attention. It might affect your bonus. It might trigger some internal reviews. But what about a $24 million fine? That changes your quarterly earnings. That will trigger your shareholder letters. That gets people fired. That will make headlines. And here's the trend line. Regulators are not done. Expect those numbers to keep rising through 2027 and beyond. And the second number in terms of regulatory inquiries, which is up 190% per bank annually. Regulatory inquiries have indeed grown from 12 in 2023 to more than 35 in 2026. That is nearly a threefold increase in the volume of questions, requests, information demands, and examinations coming from regulators. And what does this mean operationally? Let me paint a picture. It means your compliance team is spending more time answering regulator questions than ever before. It means less time for proactive risk management. It means your best people, your most experienced investigators are buried in document requests instead of preventing problems. And every hour they spend responding to a regulator is an hour they are not spending on your trade finance operations. The third number, resolution time doubled. The average time to resolve a compliance issue has gone from 45 days to 90 days, which is twice as long. And why does this matter so much? Because every day a compliance issue remains unresolved, capital is tied up, transactions are delayed, and client relationships are strained. If you are an exporter waiting for a compliance review to clear so you can get paid, 45 days feel like an eternity, 90 days feel like forever. And that exporter will remember which bank caused the delay. They will remember when it is time to choose a banking partner for their next trade deal. Number four, in terms of compliance staffing, up to 87%. The required compliance staff per $1 billion in trade assets has grown from 8 people to more than 15 people. This is an 87% increase in human resources just to stand still, not to improve, not to get ahead, not to reduce your risk posture or enhance your monitoring capabilities. Just to keep up with the current regulatory burden. And here is the killer. Those 15 people are expensive. They are hard to find. The talent pool for experienced trade finance professional, especially in compliance, is shallow. The competition for those people is fierce, and the cost of hiring and retaining them is rising every year. So what does these four numbers tell us when you look at them all together? They tell us that the enforcement landscape has fundamentally shifted. Regulators are not just looking for isolated violations. They are looking for patterns, for systemic issues, for audit failures. They have more resources, they have clearer mandates, they have demonstrated tariff fine after fine, enforcement action after enforcement action, and they are willing to use both. Expect greater scrutiny, larger penalties, and longer resolution times through 2027 and beyond. This is not a temporary spike that will reverse when the regulator cycle turns. This is not a tough on compliance phase that will pass. This is the new normal. And that brings me to what may be the most important compliance reminder I give you today. It is so important that I'm going to dedicate the next slide entirely to it. Let me start with a statement that every compliance officer, every trade finance officer, every bank board member, and every technology vendor in this forum needs to hear, write down, and remember. Regulators now demand explainability, not just accuracy. I want you to pause and think about what that means, because it is a fundamental shift in how compliance has been measured for decades. For years, for generations, really, the metric that mattered in compliance was accuracy. How many sanctions hits did you catch? What was your true positive rate? What was your false positive rate? What was your precision? What was your recall? These are important metrics. They always have been. They always will be. But in 2026, they are no longer sufficient. Accuracy alone will not protect you in an audit. Accuracy alone will not satisfy a regulator who asks why. and accuracy alone will not produce the audit trail you need to defend your decisions. Let me give you a concrete example because this is not theoretical. This is happening right now in trade finance department exactly like yours. Imagine you have an AI model that screens trade finance transactions against global sanctions lists. This is a real use case. Many of you have either implemented this or are considering it. Now imagine that this model is extremely accurate. Let us say it catches 99% of all true sanctions violations. It generates very few false positives. By every traditional metric, precision, recall, F1 scores, it is a world-class system. It processes millions of transactions per day. It flags suspicious activity in milliseconds. It has reduced your manual screening workload by probably up to 70%. Your operations team love it because it makes their job easier, and your compliance team also love it because it catches things they used to miss. But here's the problem. The model is a deep neural network with millions of parameters. It is a model that combines dozens of algorithms. It produces a score, a sanction risk score, but it cannot tell you why it produces that score. It cannot tell you, I flagged this transaction because the counterparty's address is 80% similar to an address on the OFAC SDN list, as an example. It cannot tell you that I flagged this transaction because the shipping route originates in a high risk jurisdiction and the commodity matches a known TBML typology and the counterparty appeared in adverse media maybe 60 days ago. It cannot tell you anything. It just produces a number or it is just another black box. Now, let me tell you inside a regulatory audit, because this is exactly what is happening at banks around the world right now. The regulator, let us say it is the Monetary Authority of Singapore or the OCC in the United States or the ECB in the Europe, has selected a sample of your trade finance transactions for review. Among those transactions is one that your AI flagged for sanctions review. Your team investigated, found no violation, and released the transaction. The regulator looks at the file and says, the transaction was flagged, explain why. And what you say, our AI flagged it, the regulator says, why? And you say, because the model output a score above our threshold, and the regulator response here will be, why that score? What specific factors contributed to that score? Which data elements drove the decision? Was it the counterparty name, the address, the commodity, the shipping route, the transaction amount, the historical pattern? And you cannot answer these questions because your model cannot tell you, because you prioritize accuracy over explainability, because you probably bought a black box. And this scenario is no longer acceptable today, not in 2026. Black box AI is now a legal risk. Opaque model that cannot articulate the rationale behind a sanctions flag or compliance decision will not withstand regulatory scrutiny. Explainability is not a nice to have feature. It is not a best practice recommendation from an industry association. It is now a legal requirement in multiple major jurisdictions. And let me be specific about which regulators are demanding this, because vague claims do not help you. The European Central Bank has issued formal guidance on the use of AI in financial services. That guidance explicitly states that models used for regulatory compliance must be interpretable. If you cannot explain how your model reaches its decision, the ECB will not accept it. And another example, Monetary Authority of Singapore has been who has been a global leader in this particular area. And their FEAT principles, which includes fairness, ethics, accountability, and transparency, are now baked into their supervisory expectations for AI in banking. The Office of the Comptroller of the Currency in the US has also made it clear that banks using AI for compliance must be able to explain model outcomes to examiners. Additionally, the Prudential Regulation Authority in the UK has issued similar guidance. This is not a niche concern, this is the global regulatory consensus taking shape in real time. And the requirements just go beyond just explainability. Emerging rules mandate complete timestamp audit trails for every compliance action, whether that action was automated by AI or assisted by human. Think about what that means for your daily operations. Every time your system flags a transaction, that flag must be recorded with a timestamp, with a user ID, with a clear rationale. Every time an analyst overrides a flag, decides that a suspicious transaction is actually legitimate, that override must be recorded with a timestamp, with a justification, with a note on what evidence led to that decision. Every time a transaction is approved, escalated, or rejected, that decision must be auditable years later, not hours later, not days later, years later. If your AI cannot produce a clear human readable rationale for why a decision was made, if your system cannot generate an audit trail that a regulator can follow, it will not hold up in audit. Full stop, no exceptions. And here's the financial reality that makes all of this urgent. We saw this on the previous slide, but let me repeat it because it bears repeating. Non-compliance costs have tripled since 2023. The 12 regulatory inquiries per year are now 35. The 45-day resolution timelines are now 90 days. Regulators are no longer issuing warnings. They are issuing fines that materially impact institutional profitability, and they are doing it with greater frequency, greater severity, and greater public visibility. And this is critical. I do not want anyone on this forum to walk away thinking that this is only a bad news, because there is an upside, a significant one. The upside, why explainable AI is a competitive advantage. Let me explain why. Because this is counterintuitive. You might think, if I have to add explainability, if I have to generate audit trails, if I have to document every decision, that is going to slow me down. That is a reasonable concern, but it is wrong. And let me tell you why. Consider two banks processing the same trade transaction. Bank A uses a black box AI model. The model is very fast. It flags or clears transactions in milliseconds. But when it flags something, the model cannot tell the compliance analyst why. So the analyst has to start from scratch. They have to pull out the transaction details. They have to review the counterparty. They have to check the sanctions list manually. They have to look at the shipping documents. They have to call the corresponding banks. And this investigation will take hours and maybe even days. Bank B uses an explainable AI model. It is also very fast, just as fast as Bank A's model, but when it flags a transaction, it does not just output a score. It outputs a rationale. I flag this transactional because the counterparty's address matches 80% of an address on the SDN list, as an example. The specific fields that triggered the flag are the street name and the postal code. The confidence level is probably 92%. The three most similar addresses in the training data are X and X. Now, what happens when Bank B analysts investigate? They do not start from zero. They have a head start. They know exactly why the transaction was flagged. They know which data elements to examine. They know the confidence level. They can validate, escalate, or override in minutes instead of hours. This is the upside of explainability. When you can clearly explain why a transaction was approved or flagged, you reduce friction. You reduce the back and forth with counterparty banks who are also trying to comply. You reduce the manual reviews. You reduce the delays. Explainability is not a compliance burden. When implemented correctly, it is a competitive advantage. The banks that figure this out first will process transactions faster, pass audits more easily, and win more clients. The banks that ignore it will drown in manual reviews, audit findings, and margin erosion. So here's my question to you as we wrap up this particular slide. When you look at your trade finance compliance systems today, the AI models you are using or planning to use, can they pass the explainability test? If a regulator walk into your office tomorrow and asks, why did your AI flag this transaction? Could you answer? If the answer is yes, you are ahead of the curve. Protect that advantage. If the answer is no, or I am not sure, or I think so, but I would need to check, then you have work to do. And the clock is ticking because the institutions that master explainable, auditable, regulator ready AI will define the next generation of trade finance. The rest will spend their time explaining to regulators why they cannot explain. Now, let me shift from compliance and regulation to the practical question of how you can actually build digital agility in your trade finance operation. Over the next several slides, I'm going to show you how leading institutions are turning compliance pressure into competitive advantage, not by having their way out of the problem, but by automating their way out. What digital agility actually means here, because it is not what most people think. For example, live examples of AI in action, real-time fraud detection, intelligent document processing, and what leading institutions are achieving right now. In terms of the measurable ROI of digital agility, the numbers you can take to your CFO, and here is the most important thing I want you to remember about this section. Digital agility is not a technology project. It is not something you buy, install, and check a box. It is an organizational capability, the ability to respond to regulatory change, market shifts, as well as client demands, without friction, without delay, without manual intervention. The banks that have this capability are not just surviving the compliance wave, they are leading through it. And let me show you what I mean through subsequent slides. Before we look at examples, let us define a key term, digital agility. As mentioned, digital agility is not a technology project. It is not about buying a new software platform. It is an organizational capability. It is the ability to respond to regulatory change, market shifts, as well as client demands without friction, delay, or manual intervention. There are three pillars to digital agility. First, real-time decision making. Automated workflows that approve, flag, or escalate trade transactions instantly without waiting for human queues or batch processing window. Second, in terms of scalable compliance. Compliance infrastructure that grows with transaction volume, absorbing regulatory change without proportional headcount increase. When a new sanction list is published, your system updates automatically. Third, in terms of integrated ecosystems. APIs and open platform that connect banks, corporates, customs, and regulators, creating seamless straight-through trade journeys. Digital agility is not about moving faster, it is about moving smarter. Now, let me show you what this looks like in practice. What does digital agility looks like in a trade finance operation? Let me give you two live examples. Example 1, real-time fraud detection. Traditional fraud detection runs on batch processes, end of day, end of week. By the time a suspicious transaction is flagged, funds may have already moved. Real-time fraud detection using AI changes that. Machine learning models continuously monitor payment flows for irregular patterns and outliers. Behavioral analytics profile trade parties, their history, their counterparts, their typical transaction size. When something deviates from the norm, the system flags it instantly. And the result, suspicious activity reporting filing is accelerated by 40 to 60%. That means less investigator workload and lower regulatory exposure. Example 2, intelligence document processing or IDP. A typical trade finance transaction involves reviewing multiple documents. Example, bills of lading, commercial invoices, certificates of origin, packing lists, insurance certificates. Staff manually extract data from each document and cross-check for discrepancies. IDP automates that. The system auto-extracts structured data from all those documents. It cross-matches information across 10 or more document types simultaneously. flagging discrepancies in seconds, not hours. And the result, manual touch points reduced by up to 70%. Your trade your trade operations team is freed from data entry and document checking so they can focus on exception handling and client service. For AI, for AI's sake, these are applied solutions targeting the highest friction points in trade finance operations. Let us look at the numbers because ultimately this has to make business sense. Letter of credit discrepancy checking. Before AI, this took 2 to 3 days of manual review. After AI, it takes 15 minutes. That is 95% faster. Document processing cost per transaction. Before AI, $25 per transaction. After AI, $7 per transaction. That is a 72% reduction in costs. Suspicious activity report filing time. Before AI, 8 hours per report. After AI, 3 hours per report. That is 62% faster. EBL settlement time. Before EBL and AI, 5 to 10 days. After digital workflows, same day settlement, that is 80% faster. Now, let me give you a real world ROI example. A mid-sized bank processing about 50,000 trade transactions per year invests $500,000 in IDP, fraud detection and staff training. And what do they get? Annual savings from reduced staff time, probably at about $400,000. Penalty avoidance due to lower compliance failures, $300,000. Faster settlement in terms of working capital benefits. For example, savings of $500,000 with a total annual savings of up to $1.2 million. And in terms of net ROI in 1 year, it is at about 140%. These are not projections. These are some of live results from early adopters across Asia, Europe, as well as the Middle East. AI has moved beyond pilot projects and proof of concepts. It is now foundational to trade finance operations. Institutions that treat AI as optional are already falling behind in processing speed, risk accuracy, and compliance throughput. Intelligence document processing reduces manual review from hours to seconds, not minutes, seconds. Real-time fraud detection flags suspicious activity instantly, not through end-of-the-day batch processes, but as the transaction happens. Predictive risk scoring uses AI to assess counterparty, country, and commodity risk dynamically, enabling more accurate credit decisions at speed. The banks that are winning in trade finance today are not the ones with the largest compliance teams. They are the ones using AI to make their compliance team smarter, faster, and more effective. Let me quickly summarize the key use cases that are deployable today. Automated letter of credit checking. AI reduces discrepancy checking from days to minutes, improving first presentation accuracy. AI fraud detection detects duplicate financing, document fraud, and suspicious trade flows in real time before funds are released. Straight-through processing, end-to-end automation from application to issuance to settlement, cutting operational costs per transaction. SME digital onboarding, streamline digital KYC and trade finance application processes, remove barriers from small and mid-sized exporters. These are not future concepts. They are live in production and leading institutions around the world. Over the next several slides, I'm going to walk you through the legal and industry framework that makes digital trade possible. 1. The 3 core instruments of trade finance because we need to be speaking the same language. 2. What is an electronic bill of lading actually, and why it is the cornerstone of paperless trade. 3. The legal foundation, MLETR, the countries that have adopted it and what it means for your daily operations. And here is where most important thing I want you to remember about this section. The legal frameworks are catching up to the technology. Countries are passing laws that give digital trade documents the same legal standing as paper. Banks that wait for full industry adoption will be playing catch up with competitors who move early. And let me start firstly with the basics. Before we dive into the ICC's paperless playbook, let me establish a shared foundation around three core instruments that sit at the heart of documentary trade finance. Think of this as the three pillars of trade finance, each serving a different but essential purpose. First, the letter of credit, or you call it as the LC. A letter of credit is a bank's irrevocable promise to pay a supplier once documents proving shipments are presented. The buyer does not pay until goods are shipped. The seller gets paid as long as they present the right documents. The LC eliminates counterparty risk for both sides of the transaction. It answers the question, will the seller get paid? Second, the bill of lading, or BL. The bill of lading is the single most important document in an LC transaction. It proves that goods have been shipped. It serves three functions: a receipt for the cargo, a contract of carriage, and critically, a document of title. Whoever holds the original BL owns the goods. Presenting the BL is what triggers payment under an LC. It answers the question, have the goods actually been shipped? Third, the bank guarantee. A bank guarantee is a bank's promise to cover a loss if a buyer or seller fails to meet their obligations. It is like an insurance policy, but issued by a bank. Common examples include performance bonds to ensure a project is completed, advance payment guarantees, protecting a buyer who paid upfront, tender guarantees, securing a bid for a contract, and warranty guarantees, covering defects after delivery. The bank guarantee answers the question, what if something goes wrong? And how these three instruments work together. The LC and BL are directly linked. The BL triggers payment under the LC. The bank guarantee is separate, but often used alongside them, especially in large transactions like constructions, infrastructure, as well as energy projects. And here is the important part for today. All three are going digital. Under MLETR and ICC standards, we have now EBL, electronic bills of lading, digital LCs, fully paperless letters of credit, smart guarantees, programmable self-executing bank guarantees. When we talk about the paperless trade playbook, we are not just talking about one instrument. We are talking about the complete digital transformation of trade finance. And now, let me show you what this means in practice. An EBL, or electronic bill of lading, is the digital equivalent of that paper document. It carries the same legal rights and functions, but it can be created, signed, transferred, as well as surrendered instantly online. Instead of a paper document traveling by courier for 5 to 10 days, an EBL moves in seconds. And because it is digital, secured by cryptography and recorded on immutable ledger, it cannot be forged or duplicated. Think of it this way. EBL is to paper bill of lading as email is to postal mail. Email did not replace postal mail overnight, but today, no business would choose to send a letter by courier if email could do the same. That is where trade finance is heading. Earlier, I've introduced the ICC. Let me now give you a deeper look at who they are and why their paperless playbook matters. The ICC, International Chamber of Commerce, was founded in 1919. Its founding mission was to promote peace and prosperity through open trade. Today, its members include banks, law firms, manufacturers, trading companies, and logistic providers from over 170 countries. Three things you should know about the ICC. First, the ICC creates the rules that banks and traders follow worldwide. You may have heard of UCP 600, the Uniform Customs and Practice for Documentary Credits, This is the ICC rule. Every time a bank anywhere in the world issues a letter of credit, it follows UCP 600. The ICC also publishes intercoms, the standard trade terms like FOB, CIF, and EXW. These terms define who pays for the shipping, who bears the risk of loss, and who arranges custom clearance. Without ICC rules, every trade transaction would require its own custom contract. The ICC created a common language for global commerce. Second, the ICC provides dispute resolution. The ICC International Court of Arbitration is one of the world's most respected bodies for resolving trade disputes. When a buyer and seller disagree across borders over quality of goods, delivery terms, or payment, the ICC will help to settle the case without years of litigation. Third, and most relevant to this webinar, the ICC is leading the paperless trade movement. The ICC has developed digital standards that make electronic bills of lading, digital promissory notes, and smart guarantees legally equivalent to paper documents. They have created the ICC Digital Trade Standards Initiative to align industry practices worldwide. So when we talk about the ICC's paperless trade playbook, we are talking about the global standard setter telling the industry, paper is no longer the default. Digital is now the standard. Banks that align with ICC standards can interoperate seamlessly with correspondent banks worldwide. Those that do not will struggle to connect, to comply, and to compete. And now, let me share a really encouraging trend. Because for years, people talk about EBLs as if they were a futuristic fantasy. One day, maybe we'll have electronic bills of lading. Well, that day is here today. According to the Digital Container Shipping Association, the DCSA, EBL adoption has grown from just 1% in 2021 to 11% by the mid of 2025. This is an 11-fold increase in just 4 years. Now, 11% might not sound huge, but here's why it matters. When you go from 1% to 11%, you are not just seeing incremental growth. You are seeing the early adopters prove that it works. You are seeing the pioneers pave the way. And here's what really interesting. Nearly half of all industry players, shipping lines, freight forwarders, banks, are now using EBLs in some forms, not just for pilots, but for live transactions, real money, real cargo. The DCSA has set an ambitious target, 100% EBL adoption in container shipping by 2030. That is only about 4 years from now. Think about that. In 4 years' time, every major container shipment in the world could be using an electronic bill of lading instead of a paper one. So the question is not whether EBL will become the norm. It will. The question is whether your institution will be ready when it does. Will you be leading that transaction or scrambling to catch up? The momentum is building, the train has left the station, and the question is, are you on it? This slide is a title slide, but it represents something much bigger. It represents the fundamental shift that is happening right now, not in 5 years, not in 10 years, right now. For decades, the biggest obstacle to paperless trade was not technology. We had the technology. The biggest obstacle was the law. A digital document had no legal standing previously. A court would not recognize it, a bank could refuse it, a regulator could penalize you for using it. That wall is now crumbling. We are seeing landmark legislations passed in major trading nations. The UK, Singapore, Germany, France, more countries are following every year. We are seeing both industry commitments from organizations like the ICC, SWIFT, G7. These are not fringe groups. These are the institutions that run global trade. And we are seeing measurable progress from 1% EBL adoption to 11%, from legal uncertainty to legal recognition, from maybe one day to available today. The paperless revolution is not a future event. It is happening now. And it is turning the promise of faster, cheaper, more secure trade into an enforceable, measurable reality. Let me show you exactly how this is playing around the world. Now, let me show you something really exciting. Because for years, the biggest excuse for not going paperless was that the law doesn't allow it. Well, that excuse is disappearing country by country. Let me take you on a quick journey around the world to see how legal frameworks are catching up to technology. The United Kingdom passed the Electronic Trade Documents Act in 2023. This law gives electronic bills of lading, digital promissory notes, and other electronic trade documents full legal standing under English law, which governs a large percentage of global trade contracts. Singapore has amended its Electronic Transactions Act to recognize digital trade documents as legally equivalent to paper. Germany has adopted similar legislation. France adopted MLETR, which I'll explain in a moment, into a national law in 2025. In 2026 and beyond, further jurisdictions are expected to follow, including major trading nations across Asia, the Middle East, and Latin America. A global legal foundation for paperless trade is being built country by country. The Bill of Exchange has been a cornerstone of trade finance for centuries. It is return order from one party to another to pay a fixed sum of money on a specific date, but it has remained stubbornly paper-based until today. Legal recognition of electronic bills of exchange allows institutions to replace slow physical processes with a full digital native model. And what changes here? Elimination of printing, signing, and physical delivery. No more couriers, no more wet signatures, no more lost documents. Near instant endorsement and transfer. The bill can move from seller to buyer to bank in seconds. And reduce fraud and document loss risks, whereby digital records are tamper evident. Billions in working capital release. Faster processing here means faster payment and faster access to cash. This is not a small improvement. It is a transformational of one of the trade finance oldest instruments. Legal frameworks are finally catching up to technological possibility. For years, the technology for paperless trade existed, but the law did not recognize it. Now that the barrier is falling, we are entering an era where digital documents have the same legal weight as paper. Let me explain a term you will hear more and more, MLETR, which stands for Model Law on Electronic Transferable Records. This is a legal framework created by the United Nations Commission on International Trade Law. The purpose of MLETR is simple but powerful. It gives electronic trade documents the simple and same legal standing as paper. Under MLETR, an electronic bill of lading is just as valid as paper one. A digital promissory note is legally enforceable. A smart guarantee can be executed automatically. The ICC has built its paperless trade standards on MLETR. Multiple jurisdictions have now enacted MLETR-aligned legislation, including the UK, Singapore, France, and Germany. And why does this matter? Without legal recognition, a digital document is just another PDF. It has no legal weight. A bank could refuse to accept it. A court could refuse to enforce it. With MLETR, that digital document becomes a legally binding instrument, exactly like its paper counterpart. Banks that wait for full industry adoption will be playing catch up with competitors who move early. The legal foundation is already in place. The question is whether you will build on it. And let me walk you through how EBL changes daily operations step by step. Step 1, in terms of creation. Instead of printing a paper bill of lading, the carrier issues an EBL on digital platform. The EBL contains the same information: shipper, consignee, vessel name, container number, description of goods, weight, and any special instruction. Step 2, transfer. The EBL is transferred electronically from the shipper to the buyer to the bank in seconds, not days. Each transfer is recorded on an immutable ledger. No courier, no risk of loss, no waiting. And step 3, in terms of surrender. At the destination port, the EBL is surrendered digitally. The buyer takes possession of the goods immediately. No waiting for paper to arrive. And in terms of real-world impact in 2024, a major electronics exporter reduced its letter of credit cycle from 14 days to 3 days by switching to EBL. That is 11 days of working capital unlocked per shipment. What else changes? In terms of digital promissory notes, it streamlines receivables financing. A supplier can issue a digital promissory note and transfer it to a bank or in seconds, not days. And for smart guarantees are programmable, self-executing instruments that reduce manual issuance steps and accelerate beneficiary access. When conditions are met, payment is triggered automatically. This is not a future vision. These instruments are legally recognized and operationally available today. Beneath the surface of trade finance, foundational infrastructure is undergoing a generational shift. ISO 222 messaging is the new standard for financial data exchange. It enables seamless interoperability across banks and borders, replacing fragmented proprietary protocols. More data, richer content, fewer errors. And the next one, for blockchains and digital platform, this provides immutable shared trade records. Once a document is recorded on a blockchain, it cannot be altered or deleted. That means reduced document fraud and accelerated multi-party transactions. Finally, in terms of real-time processing, which is now a competitive baseline, not a differentiator, corporate clients expect same-day settlement and instant status visibility. If you cannot offer that, they will find a bank that can. As you can see, the rails of trade finance are being rebuilt for 3 purposes: speed, transparency, and trust. Legal recognition, electronics identity frameworks, and global standards from ICC, SWIFT, and the G7 are converging. The barriers that once blocked digital trade document adoption, legal uncertainty, lack of standards, technical fragmentation, are being systematically dismantled. The question is no longer if digital trade will happen, it is how quickly your institution will embrace it. Now, let me give you a practical way to start. And this is the last part in terms of the roadmap. Over the next several slides, I'm going to give you a practical 5-step framework that you can take back to your desk. Step 1, in terms of mapping, identify your top compliance pain point. Step 2, score, rate your current paperless readiness. Step 3, pilot, run one focused AI use case. Step 4, integrate, connect real-time fraud detection to your settlement rails. And step 5, scale, institutionalize agility with quarterly reviews. And here's what I want to remember. I want you to remember about this roadmap. Each step is designed to deliver measurable outcome with your existing operational structure. You do not need a multi-year transformational program. You do not need to onboard approval for a 9-figure technology budget. You need to start, and this roadmap shows you how. And I'll walk you through each step on the subsequent slides. Here is the 5-step roadmap you may take back to your institution. Step 1, map. Identify your top 3 compliance pain points, such as, are they sanction screening, document discrepancies, trade-based money laundering exposure. Rank them by operational costs and regulatory risk. You cannot fix everything at once. Start where the pain is at the greatest. Step 2, in terms of score. Rate your current paperless readiness against ICC and MLETR standards. Benchmark your document digitization rate. How many of your bills are electronic? How complete are your audit trails? Score yourself honestly. Step 3, pilot. Run one focused AI use case. I recommend starting with intelligent document processing on import letter of credit workflows. Measure the throughput improvement within 90 days. Do not try to transform everything at once. One corridor, one document type, one pilot at a time. And step 4, integrate. Connect your real-time fraud detection to Swift GPI and blockchain settlement rails. Ensure compliance signals flow seamlessly across your correspondent network. Integration is where the magic happens, connecting systems that used to be siloed. Step 5, scale. Institutionalize agility with a quarterly internal review cycle. We assess your compliance posture, technology performance, and paperless adoption milestone every 90 days. What worked, what did not, what is the next pilot? For those new to trade finance, start with step 1 and step 2. You do not need to digitize everything at once. Pick one trade corridor, run one pilot, measure the results, then expand. Practical, not theoretical. Each step is designed to deliver measurable outcomes within your existing operational structure. Now, let me bring everything together because we have covered a lot of ground today, and I want to make sure you see how all of the pieces fit. Let me take you back to where we started. We began with the paper prison, 50 documents per shipment, 5 to 10 days of courier time, 4 billion paper documents floating around the world at any given moment. Working capital frozen for weeks, small businesses locked out of trade finance. That was our starting point, a system that was built for a slower, less connected, less regulated world. Then we look at the new reality of 2026. 53% of banks now say compliance is their number one challenge. Explainable AI is no longer optional. It is a legal requirement. Penalties have tripled since 2023. Regulators are demanding full audits for every automated decisions. The cost of doing nothing is real and it is rising. Then we look at the solution, AI and digital agility. Real-time fraud detection that flags suspicious transactions as they happen, not at the end of the day. Intelligent document processing that reduces manual touchpoints by up to 70%. Straight-through processing that turns days into hours, and the numbers are clear. 95% faster LC checking, 72% lower document costs, 140% ROI in 1 year. Then we explored the ICC's paperless trade playbook, EBL adoption growing from 1% to 11%, the digital container shipping accession targeting 100% by 2030, MLETR, the UN legal framework, giving digital documents the same legal standing as paper, the UK, Singapore, Germany, France, country by country, the legal barriers are falling. And finally, we walk through a 5-step roadmap, map, score, pilot, integrate, scale. These are practical and actionable, designed for your existing operational structure. So here is what all of this adds up to. There is a gap. Between the data, we have the decisions we need to make. Between the regulatory pressure we face and the agility we need to respond. Between the paper-based past and the digital future. We call that intelligence gap. And closing that gap is a central challenge and the biggest opportunity in trade finance today. Because here is the truth. Compliance pressure is not going anywhere. It is accelerating. The CGI and BFT survey told us that. The regulatory mandates for 2026 told us that. The rising penalties told us that. But this is the important part. Institutions that master digital agility will turn that regulatory complexity into a sustainable competitive advantage. Think about what that means. Faster approvals. When your AI is explainable and your audit trails are complete, your correspondent banks will trust your decisions, less back and forth, less delay, and less friction. And in terms of lower correspondent friction, seamless interoperability means fewer manual checks, fewer errors, fewer rejected transactions. As for quicker cash conversion cycles, days become hours, hours become minutes, working capital gets free. For stronger client retention, when trade finance works smoothly, when documents move instantly, when payments are predictable, when compliance doesn't get in the way, Clients notice and they stay. That is the price. That is why closing the intelligence gap matters. This webinar was designed to do exactly that, to give you the frameworks, the benchmarks, and the playbook to move from where you are today to where you need to be in 2026 and beyond. You now understand the problem, you have seen the solutions in action, you know the legal foundation, and you have a roadmap. The only question left here is, what will you do next? And for the closing, we have reached the end of our journey together. And let me take the final 60 seconds to remind you of what we have covered today. Because this is important and I want this to stick in your mind. First, we saw the problem, the paper prison, 50 documents per shipment, 5 to 10 days of career time, billions of dollars in working capital frozen, a system built for a slower world struggling to keep up. Second, we look at the new regulatory reality of 2026. 53% of banks say compliance is their number one challenge, overtaking technology investment for the first time. Explainable AI is now a legal requirement. Penalties have tripled, the cost of non-compliance is real and it is rising. Third, we explore the solution, AI and digital agility, real-time fraud detection, intelligent document processing, 95% faster LC checking, 72% lower cost, 140% ROI in 1 year, not projections, but live results. And fourth, we walk through the ICC's paperless trade playbook, EBL adoption growing from 1% to 11%, 100% target by 2030, MLETR, the United Nations legal framework, giving digital documents the same legal standing as paper, country by country, the barriers are falling. And finally, we gave you a roadmap, map, score, pilot, integrate, scale, and these are practical and actionable methodology designed for your existing operations. So here is the bottom line. The transformation of trade finance is not a future event. It is happening now. It is being led by the ICC, enabled by AI, and accelerated by regulatory pressure. The question is not whether to embrace it. The question is how quickly you will lead it. Now, a few important next steps for you. First, please use the link in the chat box or on this slide to submit your questions. Our team will review and every submission will provide you with a personalized written answer. For complex questions, we may schedule a brief follow-up call at your convenience. And if you are ready to take the agility to the next step, we are offering also a complimentary digital agility gap analysis. We'll assess your paperless readiness, score you against the ICC standards, and provide a customized 5-step roadmap. No fees, no obligation, just practical help. Finally, the recording of this webinar will be shared. You'll receive an email with a link, and I want to leave you with one final thought. Trade finance is the backbone of global commerce. Every product you use, every meal you eat, every device you are holding right now, at some point, it crossed a border, and trade finance made that possible. For too long, that backbone has been held together by paper, slow, fragile, and expensive. But that is changing. And for those who change with it, who embrace digital agility, who adopt the ICC standards, who close the intelligent gap, will not just survive, they will lead. Thank you for your time today. I look forward to reading your questions and supporting your journey. Among one of the questions, you mentioned EBL adoption is only 11%. What is holding the industry back, and what is the fastest path to adoption for a mid-sized bank? Okay, this is indeed a great question, and the 11% number is both encouraging and sobering. Regarding what is holding back the industry, what we can see is three main barriers. First, in terms of the legal recognition. Until recently, many countries did not recognize these EBLs as legally equivalent to paper, and that barrier is indeed falling apart. The UK, Singapore, Germany, France, and others have passed MLETR-alike legislation. but not every jurisdiction has caught up with this. And second, in terms of correspondent network effects, an EBL is only useful if your counterparties can accept it. Okay? If your trading partner is still using paper, you are still forced to use paper too. And this is a classical network problem. And thirdly, in terms of technology investment, many banks, especially mid-sized banks, have not prioritized EBL infrastructure. They have other technology projects that they feel more urgent. But as we discussed today, the regulatory deadlines are making EBL adoption urgent. And to address your question on what is the fastest path to adoption for a mid-sized bank, let me give you a three-step approach. The first step, start with your highest volume trade corridor. Pick one counterparty, one shipping line, one trading partner that is already EBL capable and pilot with them. Step two, use a platform that connects to multiple EBL networks. Do not build your own. Use an existing infrastructure provider. And thirdly, set a target. The DCSA has set a 100% target for container shipping by 2030. That is the industry direction. Set an internal target, let's say 50% EBL adoption by the end of 2027, and measure your progress quarterly. The banks that move first on EBLs will have a competitive advantage, faster settlement, lower cost, as well as better client experience. Okay. As the time is running out, we'll address the rest of the questions manually. And thanks for your time again today. Thank you and have a good day ahead.